The risk of an investment is measured by the variability of the returns. When calculating the risk of an investment, the terms variability and variance are often used interchangeably. The variance essentially shows the spread of actual data points around their mean value. The mean value is the expected return. An investment with a low variability in returns is associated with a low degree of risk. An investment with a high variability in returns is associated with a high degree of risk. When evaluating an investment, we first have to determine the expected return. Secondly, we have to calculate the variance. Then we calculate the standard deviation. The standard deviation is a measure of how spread out the returns are. Lastly, we compare the expected risk to the expected return. The greater the variability or variance or spread around the expected return, the greater the risk. The risk is higher because the likelihood of a loss is higher. Let's look at an example. In the example, we have two companies, Company A and Company B. Provided are three possible states of the economy: the probability or likelihood of each state occurring, and the associated returns. There is a 30% chance that the economy will boom, and if so, Company A will generate a return of 30%, and Company B will generate a return of 12%. There is a 40% chance that the economy will stay the same, and if so, Company A will generate a return of 15% and Company B will generate a return of 10%. There is a 30% chance that the economy will enter into a recession, and if so, Company A will make a loss of 10% and Company B will generate a return of 8%. From the information provided, without doing any calculations, we can conclude that Company A is riskier because there is a higher variation in returns. To calculate the expected return, we have to multiply the possibility of the state occurring, or the probability, with the associated rate of return. So for Company A, we'll take the three probabilities and multiply each of them with the associated rate of returns. So 0.3 times 30, 0.4 times 15, and then again a 0.3 times minus 10. So once we have these weighted figures, we add them up. So 9 plus 6 minus 3 is 12. Then that is the expected return. So for Company A, it's 12%. We do the same with Company B. (0.3 times 12), 0.4 times 10, and 0.3 times 8. Then we add them all together and we'll get 10%. So the expected return for company B is 10%. So now, just because the expected return for company A is higher doesn't mean that we're going to invest in company A, because we first need to determine the risk. If the risk is greater, in other words, if the variation in return is greater for company A, then we'd rather invest in company B, because then company B would be a safer investment. And as I mentioned earlier, without doing any calculations, I can already see that the variation for company A is greater, because look at this big difference here, 30 versus 15 versus minus 10. And then over here for company B, we have a lower variation. The difference is smaller, 12 versus 10 versus 8. So the degree of risk here for company B is lower. Right, so now let's calculate the risk. When we calculate the risk, we start with the associated return. So for company A, the associated returns are 30%, 15%, and minus 10%. Please do not make the mistake of taking the weighted rates of returns. Then we find the difference between the associated returns and the expected return. The expected return is the return that we've calculated over here. So for company A, the expected rate of return is 12%. So this stays the same in each scenario. So the difference between 30 and 12 and 15 and 12 and minus 10 and 12. Please make sure that you do the calculation correctly when there's a negative return. The next step is to get the square of the difference. So the square of 18, or 18 times 18 in other words. The square of 3 and the square of minus 22. Again, when there's a negative, please make sure that you do the calculation correctly, because when we multiply negative amount with another negative amount, the result will be a positive. So minus 22 times minus 22 is equal to a positive 484. So we'll always end up with positive amounts in the end. Then we have to multiply the square of the difference between the associated return and the expected return with the probabilities. So 324 multiplied by 0.3, 9 times 0.4, and 484 times 0.3. Once we have all three figures, we have to add them in order to get to the variance. So 246 is the variance. And then the last step is to get the square root of the variance. Because remember, we've been squaring all of the figures. So to get to the total risk, or what we call the standard deviation, we have to determine the square root of the variance. That is our risk. The risk is 15.68%. For company B, we have to do the same, so we will follow the same process. We start with the associated rate of returns. Okay, please once again remember to take the correct figures. Do not take the weighted rate of returns. It's associated rate of return minus the expected rate, which is 10%. We've calculated it over here. So it's 10 throughout. We find the difference between the associated rate of return and the expected rate of return. Then we have to square the difference. Then multiply it by the probabilities. So first we calculate the variance. So the variance is 1.2 plus 0 plus 1.2. So the sum of all of those. And then we find the standard deviation, which is the square root of the variance. So we see that it's quite small. It's 1.55%. So the risk is very low. There is a low risk for company B. In other words, the variation in returns is low. For company A, there's a high risk. In other words, the variation in return is high. There's a possibility for a loss here if it goes into negative. If we say 12 minus 15.68, so it goes, if the market goes into the opposite direction, then there's a possibility for a loss, even though it also means that the possibility for high returns is high, right? So if it goes into a positive direction, then there's a chance of a high return. So certain investors might take that risk, accept that high risk because of the chance for getting a high return. But risk-averse investors, they won't take that chance, and they will stick with a safer investment, and then therefore go with company B. So even though company B generates a return, or even though the expected return for company B is lower, it's 2% lower, a lot of people won't take the high risk, the risk of 15.68%, just to get that additional 2% in return. So a lot of people would then rather go with company B, 10% expected return with a low risk, a low possibility of variation in that expected return.